Yeah, thank you so much, Steph, and good morning, everyone. Thank you for joining us. I'm super excited to be here hosting this panel. And we're going to be talking about alternative funding. Quick introduction on me. I'm one of the co-founders of a company called FounderWay. We help early stage founders go from idea to first customer with AI tools. With that, I'm going to introduce some of the goals of what we're trying to achieve today, just so we're all on the same page. We're going to be chatting about what are the other options that founders have outside of angel investments and VC funding. And this is to help you guys understand how certain types of funding can impact your future rounds or what you're currently doing, and what are the strings that are attached or not attached to certain types of funding. With that, I'm going to start with an introduction of my wonderful panel. John, I'm going to let you kick off.
Hey everybody, my name is John Friedman. I'm the founder of Freight Farms. We got our first funds through a Kickstarter campaign, raised about 49 million of venture, did a lot of research grants, explored alternate funding, all the way to acquisition. So happy to answer any question about any type of deal stage. Currently, I'm helping startups with the structure for scale, as well as pitch presentations for fundraising. So happy to be here.
Thank you, John. Next up is Raza.
Thank you, Kaden. Hello, everyone. I'm Raza Sheikh. I'm very excited to be here. I'm an active angel investor. I invest with Launchpad Venture Group and also help run the group as one of the managing directors there. I also co-manage a small VC fund called Beacon Venture Partners and have been very involved in startup funding, fundraising in the Boston and New England area. Software and tech background, and for portfolio companies and for entrepreneurs, I've seen plenty of ways of alternate fundraising. So happy to chat with you all about that today.
Thank you. And last but not least, Jackie.
Thanks, Kieran. So hi, everyone. My name is Jackie Firsty. I'm the director of Greentown Labs Investor Program. So Greentown Labs is the largest climate tech startup incubator in North America, and we're based here in Boston, right across the river in Somerville. And so my role really is to help support startups. We have over 200 startups currently as part of our incubator. And my role is to help connect them with capital. So fundraising through equity, but also these alternative methods of funding as well that are non-dilutive. And so prior to my time at Greentown, I was actually doing community solar development. So background in clean energy, supporting startups before that as well at the Massachusetts Clean Energy Center on their investments team. So kind of seeing things from ideation through to commercial deployment and how to support them with funding. So it's great to see all of you.
That's awesome. Thank you so much, Jackie. I'm going to start off with a question for everybody in the panel. And Jackie, I'm going to, since you have the virtual mic, as we said, could you help us understand the landscape of the industry? What options are available for different kinds of startups at this point? And I think I'm going to quickly do a peek over at the poll to see what the majority of the audience is shaping up to be. Most people here are MVP prototype stage and thinking of fundraising. So if you could shed some light on understanding the landscape in the industry around alternative fundraising, and then we'll pass the mic around.
Yeah, I'm happy to get things started. So this is the kind of conversation I have with a lot of our founders who are members at Greentown when they're starting to think about a fundraise. So, I mean, obviously there's venture investment, but that's not necessarily the right fit for every company. And especially when you're kind of at that prototype stage and at an MVP stage, there are a lot of other funding resources available to you that are non-dilutive. The best for that stage is definitely things like a prize competition or grants. And there are a lot of really great organizations in the state of Massachusetts to support you with these prototypes, especially if it's in hardware, but also for software companies as well. Companies like Mass Ventures put out a lot of different grant programs. The Massachusetts Clean Energy Center, that is specific to clean energy and climate, but the Mass Ventures is not. There's accelerator programs as well that oftentimes have support money as well. So at that very early stage, those are really valuable when you're really trying to get off the ground. But then we're also opportunities for first customer financing. If you have any kinds of grants, there are organizations that do grant advances as well. If, for example, you have a grant you received, but maybe it's reimbursable. So obviously you applied for it because you needed funding, but they don't give you the funding until you spend the money. That's obviously a chicken and egg scenario. And so there are some organizations that are starting to come about that have these kind of grant advances where they can help you, knowing that that repayment is coming because you have that reimbursable grant, help you kind of advance that money. So those are some at that very early stage that are relevant. Can talk about later stage options as well, but I think maybe I'll hand it over to some of our other panelists if anyone else has anything to add.
Yeah. Raza, I see you unmuted. Awesome.
Yeah, absolutely. These are really wonderful ways or alternates in the sense that other than angel and VC, I will add to the list that you could simply bootstrap the company from orders and money coming in. You could seek advance payments or advance purchase orders from your customers to fund the thing. I've actually seen very successful companies that later became very successful do that. You also have another thing that is called friends, family, and fools. These are people who would believe in you and would be willing to give you the money. Of course, you don't want to have awkward Thanksgiving dinners, but it means that these are people that know you and willing to bet some money on you. If your business is off the type, then you may also have asset-backed traditional funding options from banks, if that's the type of business and startup you're building. And of course, we'll talk a lot more about the crowdfunding option as well, which comes in two variations. One is where you're basically pre-selling or advanced selling your product. And that's technically kind of like a donation or non-equity taking way of crowdfunding, such as a Kickstarter campaign. And the other is the equity crowdfunding, where you are giving up equity in your company, but you're raising from your customer base. I'll pause at these options. There are some advanced options as well, and maybe I'll throw it over to John to talk about those.
Thanks. Yeah, I think all of those are really great for early stage for sure. I think as you get a little bit more mature in your development, based on the type of business you are, you might want to seek project financing, especially if you're a hardware company or you're more in the infrastructure space. That will kind of help people who are lending money look at the project based on how much that project generates for capital, rather than just looking at the valuation of your company. So it's a good way to isolate the needs for capital around certain milestones. I would say, grants the whole way through. Grants are good now. Grants are even better later because you've got a lot more credibility. You've got a lot more to show. And oftentimes those grants are to take something that you've already done in theory or in practice, but you haven't really formulated it into a solid thesis. So it might feel like a lot of work, and it is a lot of work to write grants, but sometimes the actual activities that you are doing in the grant process are more of an academic process to congeal what you've already done into something that's sharper. So definitely something to think about the whole way through.
And folks, I pasted in the chat window that list of alternate funding options for your reference.
Thank you, Raza. That's so helpful. That's a great summary of pretty much everything all three of you touched upon. I love the fact that, John mentioned that all these activities that you do, whether it's for crowdfunding or for government grants or prize money, like Jackie mentioned, everything kind of requires you to do an exercise of getting to know your business and yourself a little bit better. With that, I'm going to jump into a little bit deeper into crowdfunding. John, would you shed some light and help us understand how raising money on Kickstarter, like if I raise today, later on I go for VC money, how does that impact my fundraising process or the life cycle of my company to do something like this right in the start?
Sure. Like Raza said, there's two different types of crowdfunding that you might want to go after. One is a little bit more focused on the product, pre-sales. You're giving them something for the donation, and you can use that for a wide range of things, but mostly to bring a product into market. And that's really where we found ourselves. We were in a place where the jump from an idea to prototyping was so big that we couldn't do it on our own. And we went out and basically we're just like, hey world, this is our crazy idea. What do you guys think? And that was helpful for us, not only to get a little bit of capital, but it was helpful for us to hear from the rest of the world, from places that might need our product, what they were excited about. So we used it in a wide range of ways, kind of user research and market research as well. It was helpful for us because when we were thinking about going out for our Series A or seed round, you do need a little bit of traction before you go and get that venture capital. And they want to see that you've done your best, you've turned over every stone, and that you've pushed this as far as it can go on your own and by your own means. And I think fundraising through crowdsourcing really shows that. It shows that you are willing to exhaust every resource. So for us, that got us our first prototype. It got us a lot of customers in the backlog that we could show up to any meeting and say, look, there's demand, it's working, now we're ready for that next stage. So for us, it was really helpful in fleshing out that first product. I think a lot of people are using Kickstarter particularly for a product launch, and that is a very strong platform to do that. There's other ones that if you are raising capital or you are just kind of a little bit more generalist, you might want to go, even like GoFundMe might be the right choice for you. It's a little less startup focused, but there's others in that vein that might be a better fit for you if it's a small piece of capital and you aren't really ready to go do pre-sales. One thing I will say about Kickstarter, anything pre-sale related, that is a process. That is it's a bit of work on its own. So it is nothing you should take lightly. It will take up a lot of your time. And if you do fumble that could have a bad lasting effect on the momentum of your company, not getting people orders, not getting things on time. It's not a great first impression if you don't nail it. So if you are going to go that route, it is a great way to access capital, non-dilutive capital, but it does come at a price, and that is time, and time is money. So it's just something to think about.
I can certainly second that, John. It's like that demo day where you launch your campaign and then the delivery part begins once your campaign ends, which is a totally different ball game, which Kickstarter doesn't get you ready for. So
absolutely.
Raza, would you help us understand a little bit more around your opinion? I know you wanted to talk a little bit more about that in your introduction. Yeah. I'm going to give you the floor.
I think it's just piggybacking on what John said. You have to understand as a founder that a crowdfunding campaign is a suitable way for your company. And by the way, this theme will continue that you pick the type of funding that is suitable for the type of business and company that you're building. Not only there is the time cost, but you actually end up kind of like advertising on social media. So there's actually like a CAC component to getting funding through crowdfunding, meaning it's actually very expensive to get that. It is suitable for companies of a certain type, the ones that have maybe a physical consumer product sometimes, things that have broader appeal. If it is esoteric software for optimizing production of biological processes, it may not be very suitable for a crowdfunding campaign. If it's sold B2B, it may not be. One other technical caution on raising equity funding via crowdfunding is that these type of private company raises are done through the Reg D exemption of the SEC that allows you to raise money without a lot of public disclosure that public companies have to do. And you're only able to normally raise from accredited investors, and you're not allowed to do public solicitation. Now, the Reg CF does allow you to do public solicitation and get smaller amounts from non-accredited investors, but you cannot run both of those Reg D and Reg CF fundraising campaigns simultaneously, because for Reg D, you're not allowed to do public solicitation. So two basic cautions: check for suitability, check that you may all have a natural customer base, social audience for your product that would respond to this, and know that crowdfunding does have significant costs, although now you're allowed to raise up to actually $5 million on crowdfunding campaigns.
That's really insightful and super thorough. Thank you so much for that, Raza. I'm going to hop on to another side of alternative funding, and I think Raza touched on it a little bit. What is the most suitable type of funding for your type of business, stage of business? Jackie, I would love for you to chat a little bit more about how you help companies figure that part out.
Yeah, absolutely. So obviously at different stages, different funding is going to be the right fit for you. So you might be past a first raise and then maybe a Kickstarter is not the right fit, but maybe one of those equity crowdfunding raises up to $5 million could be a better fit if you're still looking to do crowdfunding. So thinking about that at that stage. I think, again, another thing that's relevant is thinking about one of the things Raza mentioned was bootstrapping and using, orders to get funding. Obviously, if you're at an earlier stage, your technology is not developed enough to be, fulfilling orders. If, let's say, it's hardware, for example, you might have an issue with that. So you've got to think about, can I actually hit the milestones that I would need to be eligible for those types of funding? Similarly, for example, with options like revenue-based financing, again, you need to have orders, you need to have some kind of revenue coming in already to do that. Most of the companies that I work with are in the hardware space. We do have climate tech focused software companies as well, but a lot of the funding types that I'm thinking about and helping support our founders with are more hardware focused. And so sometimes you'll even have options around equipment leasing, right? Maybe you're financing a piece of equipment that you need in order to prototype your technology, or you've gotten to a prototype, but now that you're trying to get to a commercial level of production, you need different pieces of equipment, maybe at a larger scale. And then that is oftentimes something that you can benchmark against, again, potential future orders. You maybe don't have to already be able to produce them, and they're saying, hey, I need this piece of equipment in order to. There are a lot of opportunities for that as well. A lot of organizations that do that type of equipment financing as well. There's also things like venture debt. This is if you've already raised a funding round. So I'm kind of moving slowly later stage. So obviously some of this is going to be a little bit less relevant in the moment for some of the people on the line right now, but just to know these are options as you grow your company and get further along. You might want to think about venture debt. Usually that's tied to raising a venture round. And then because they have that background of, hey, you just raised a venture round, we feel confident about that. You can often get venture debt, which is associated with that, to kind of extend your runway a little bit longer. There's also options like project finance. So that's a much later stage, right? If you're building a physical project, not really relevant for software, more so for things like an energy project, or you're maybe building some plants, a physical plant that's going to be producing goods. And so that is also going to be a project that you're developing and permitting, things like that. And so that is a different type of capital, lower interest rate, because the risk is lower. So you've got to think about a lot of these alternative options, if they're a loan or financing, are going to have some type of interest. And so you have to think about that. That cost of capital is usually lower, though, than equity, pretty significantly lower. And you're not giving up a percentage of the company later down the line that you'll hopefully be able to hold on to. So these are things to think about. Yeah, that's what I'll have to share.
Thank you, Jackie. John, go ahead.
Yeah, I would second all of that. I would say, it's never too early to be thinking about what types of financing that you'll get down the road. I'm sure Raza knows this, but any investor you talk to doesn't want to finance hardware. They don't want to finance manufacturing. They don't want to finance the hard stuff. They want to see a clear path to traditional financing, like get the bank to loan you money. They want to use their money for growth. So even though you might not be able to access it now, showing kind of where that horizon comes in, where I need this money to get started. The next one is going to be a little bit of venture, a little bit of debt. And then at this point, we're all traditional financing. That might just be something as an activity for you to kind of plot out to know where that milestone is going to be. And that might help you actually figure out what type of investors to start searching for at each stage. Some companies do venture and venture debt. So it's not like one house per type. There's also things like IP-backed debt, where if you are a technology company that is maybe in the biospace, or you have a lot of patent work that you're going to do through research grants or just in this early stage, that becomes very valuable down the line, of course, for valuation, but you can actually use that as an asset to help you get debt against it. So things you do in your early stage and the way you set up your fundraise path can make it easier to get capital down the line.
I love the thought of understanding a startup's fundraising path, right? Like, you're doing something now. What are the benefits, the pros and cons later? Raza, I would love for you to, I'm going to let you have the mic.
Thank you. Both really, really good points from John and Jackie. One thing that I'll add to this mix, specifically for science, life science, healthcare, medtech, medical device startups, that for you guys, the most appropriate, most common way of that alternate funding or financing are the NIH, NSF, DoD grants, particular to your area. Grants do take a little bit of time to write, and there is a little bit of probability involved whether you'll get it or not. But that is a source of funding that later in equity investors really love, because the non-dilutive money helps make a lot of progress, and especially de-risk science. And there's a whole set of resources for you to learn, which grants are appropriate for you and how to go about getting those grants. So it's actually one of the most important alternate financing for a certain type of company.
Thank you. So much great knowledge here to understand what works for your stage of company, your industry as well. We're going to move on to understanding some of the pitfalls and mistakes that startups encounter when pursuing alternate funding, things that they've gone too quickly towards, and things they've not gone as quickly as they should have gone towards. Like Raza mentioned, investors love non-dilutive funding. Raza, I'm going to hand back the mic to you and see if you can help us understand a little bit more around the pitfalls and mistakes you've seen other startups do. If you could, provide more examples.
I think the word alternate funding has another meaning, which is that if you were building, and I'll take an extreme example, a cafe, nothing wrong with that. It can provide good coffee for the community and a good business for your family. But it requires a very different type of funding and financing strategy. So one pitfall is, and I know that was a very extreme example, but I think you want to look at the type of business that you're building. Is it ultimately your capital staging plan, meaning raise a little now, then from alternate sources, then from angels, then from VCs, and so on? Is that conducive to what you're trying to build? Are you trying to build a tech-enabled, high-growth company that can potentially grow fast? Or are you trying to build just a good business that'll grow, a decent amount, provide employment to a whole bunch of people, and you want to keep it forever and never sell or exit? And that requires you to think very different about the alternate funding sources. The one other pitfall that I'll add to this is just looking at the stage. Again, can I go for angel and VC funding now? It's only really suitable for when you have de-risked a few things, shown some traction. So it becomes a chicken and egg problem. So if you do it too early, you may not succeed, or if you, do it too late, it might be a problem as well. So those two things I'll throw as pitfalls.
Awesome. John, would you like to add some of your learnings?
Sure. Well, to piggyback off the venture piece, it's a ride. Once you get on that ride, you cannot get off that ride. So know that, kind of to what Raza was saying, you should be ready for venture and know that the stakes for venture are to keep fundraising forever until you die. It's very unlikely that you don't need access to capital. If things are going good, you should raise more capital. If things are going bad, you need more capital. It's just kind of the decision tree that ends in fundraise. So on that, there's definitely, I mentioned some of the pitfalls of crowdfunding. If you aren't prepared for crowdfunding, if it is something that you have to deliver a product, just be ready for the amount of time and commitment to that. A lot of people kind of underestimate how vicious the internet is. So definitely be ready for that. When you are looking into something like venture debt or just straight debt, while venture does have a certain pace, traditional financing is pretty cold. It's like if you got to pay that back at that time, and that's it. There's no, all right, we're going to do a bridge loan to the next round. There's really no conversation. Unless you've made a lot of money for them in the past. But if you're going to take traditional financing, you need to take that very seriously. So I would say, to come all the way back around to kind of what Raza was saying, like about that coffee shop, a boring business is a good business. So don't be enamored by the venture. Oh, I'm going to raise a ton of money. That money is going to be spent so fast. It's not a windfall of cash. It's going somewhere. It just never feels like you won the lottery. So like, if you have a good basic business, everybody wants to invest in something that's just printing money. Don't try to sell the moon if you have something really good in front of you that can be funded conservatively.
Thank you. That was, it was so experienced and lived, that opinion. Thank you so much for sharing that. Jackie, would you like to add a little bit around some of the pitfalls?
Yeah, no, this is great. I mean, what Raza and John shared is already extremely valuable. And just to kind of add on that, getting getting traditional financing is not a joke. And just in case people aren't aware, that money is senior to venture equity. So you have to pay that back before any investors will ever get their money back if they've invested in you. So that money, it's a very, very legitimate payback that needs to happen, and they will come for that money. So just you have to be careful when you take that. I mean, it can be really fantastic and a really good way to get capital at a lower cost if you have the business to back it up. So you have to be careful. And there's also, that kind of alternative financing. They take their decisions very seriously. They do a lot of underwriting of your business to understand, what is the percentage likelihood that we will get our money back? Whereas I think in venture, there's a little bit more flexibility there. I mean, obviously they're still hoping to find a business model that works, but at kind of that pre-seed or seed stage, venture investors are really looking for, for example, a financial model. They're looking at that not for the actual numbers, but for understanding the way that you're thinking about your business, right? They're like an investor that's a venture investor at the very early stages, just want to understand how you think. They're oftentimes investing in your team because they think you might be able to figure out how to execute on this business model. Whereas some of these alternative funding resources, if they're looking for payback, not saying grants, but saying, and if they're looking for a payback, they are really, really analyzing, are you going to be able to hit these numbers that you're telling us that you're going to hit? And they're going to hold you to that in a way that is a little bit different than venture investors or like a grant, for example. Grants still have milestones, so you have to be careful depending on the type of grant you receive. You want to look into that too. The grants, prize money, for example, that's not going to have any like milestones attached. It's like, you prove to us right now that you're the winner of this group, like go use that money for whatever you need. But some grants have milestones where you're writing progress reports and you have to hit, certain goals with your business to be able to get that money. And it's coming in sections, not all up front as a lump sum. So you have to also make sure that when you're applying for grants, that's something that you can actually do and that's realistic for your business. There is one company, I saw a question, so I might just like mention this and can drop it in the chat later, but there's a company specifically in the climate space that's working using AI to help find and support like proposal writing for grants. So, because I think finding the grant that is the right fit for you is a needle in a haystack. Many times there's so many options and it's not so easy to find. You have to know what organizations you're looking at. Like Raza mentioned a few that are government and depending on your sector that are specifically important for you. But definitely there's a lot of searching and digging and talking to people in the industry because some of them are not that easy to find. Everyone's like, oh yeah, they exist. And you're like, how do I even find that on the internet, right? So it's definitely, talking to people in the industry is going to be, really important for you to do.
This was so insightful. I'm like taking notes and trying to understand how I'm going to sum all this up. This is so much rich information. I think there's a lot of questions around how do I find the right type of grant around sector industry, like Jackie mentioned, your stage, and then also where you live. There might be state-wise grants, so you might want to look at that as well. And I think one of the things I want to talk about is what is the future? We already know that the funding landscape is a little bit tough right now to fundraise. People are leveraging more of the alternative funding solutions that are out there. John, what do you think, in your opinion, where do you see this go? It's a little bit of a, looking into the future and speculating.
Yeah, it's a great question. I don't have a crystal ball on this one, but I can say, in my experience, the mood swings of venture investors is a really hard thing to follow, and that usually follows the market, and that usually is governed by the stars. Who knows? So it's really hard to time it right. Like you could, in a couple of years, it could be a great time to fundraise, and it totally swings. So what everybody always says to you is like, if you can get money, if you have access to money, take as much as you possibly can when it's available, because it won't always be available. And that's so true. Like the same investor who was like, I'll invest everything in this company, 2 months later be like, ooh, actually we're not doing any more investments, and it's just out of nowhere. So you need to kind of just plan accordingly when you are fundraising, that like it might not be an endless flow. So I'd say Where's it going? I think we're fading away from like this, like everyone's a unicorn mindset. Like every tech startup's a unicorn, and we all have to go for billion-dollar valuations in the first 2 stages. So I see a lot more folks doing like safe rounds or seed stage, friends and family. So I think more support around that is great to get more people off the ground, and I see a lot more things coming out to facilitate that. Later stage, I think we need more risky banks, I guess, and venture is there for a reason on that side of things. But I think, I think early stage needs a little bit more support on finding smaller money and having that help you step up to the next level.
I totally agree. I think Raza, on the other side, venture and
Yeah,
alternative, you have a good perspective.
and this is out of left field, but I'll throw one other caution, and this may be, much advanced and much later for most of you, is the alternate funding method of venture debt, or in general, any kind of debt for a company, in addition to giving up equity. And sometimes it actually is a really, really dangerous state for the company to be in. If the company fumbles, then the debt's got to be paid first for any money that comes out of the proceeds from the sale of the company, or and oftentimes, if there is a stumble, it actually kind of results in the company dying more often than not. So getting venture debt is double-edged. You're not giving up equity and you're extending your runway. But you also want to be really, really understanding, because those are pretty high interest rate and pretty egregious covenants that you have to deal with. And if you know that you're not going to get the cash flow in to pay back that debt or its payment structure, then just be very cautious, specifically on venture debt. Hopefully, you guys have ways to go before you get there. But I want to put this in the mind of people ahead of time, because venture debt is thought of as a great way to extend runway, but it also has its downsides.
I have 1 minute before I have to wrap up this conversation. Jackie, if you have a quick thought around the future, I'd love to hear that.
Yeah, absolutely. I mean, there's a lot of conversation right now, especially in the climate and clean energy industry, around this kind of new valley of death for funding for first of a kind projects. So the first commercial scale project that a company is building, or plant or product, how to get financing for that, because venture investment doesn't really, like, taking equity to build a project at scale, maybe tens of millions, 20, 40, 50, $100 million, doesn't really make a lot of sense from a capitalization perspective. But it also, it's hard to find the right group to make that, either to finance that fully with not with equity, fully with non-dilutive funding. And so that's something that a lot of companies are really struggling with right now. There aren't that many organizations filling that gap, and we're starting to see a few come out, and even the government. I know the Office of Technology Transition within the DOE is really thinking about, how can we help fill this gap? How can we catalyze private investment into this space? And so obviously this is definitely like a climate, clean energy big point, but I think this is going to happen with hardware generally, as venture investment has kind of shifted over the last few years of how easy it is to get or not to get. And so I think that's something that there's going to be a lot of regulatory changes that are going to cause that to be more and more important, to figure out filling that gap and getting projects actually implemented at a full scale.
What a full-rounded view of having different people's opinions, living through it, serving people who are going through it, and being on the other side of that funding. I'm going to turn over to audience Q&A. So panelists, are you ready? Okay, let's do. I'm just going to put. I think I'm going to push this. I'm going to share this. Okay. Interested in opinions about revenue share investor return, whereby investor receives a fixed amount of cash or percentage of revenue until the investment is returned. Afterwards, investor retains a small equity stake versus having their capital at risk over a long period. This sounds very Mr. Wonderful from Shark Tank kind of a question. So I'm going to open the floor for one of you guys to provide some insight on this.
Yeah, I mean, revenue base or royalty base or whatever you want to call it, financing are an alternate, but again, they're suitable for certain type of companies. The repayment that you have to do from your revenue to your revenue-based lender or that agreement that you did means that you're taking away money from the growth of the company. So it's kind of if it's a small traditional business, it's not suitable. You may not have enough cash flow to pay back. And if it's a high growth business, you want it to be high growth and not spend money on. So maybe this is suitable for something in the middle, where you do know that you have reliable cash flow coming in, and you might be able to extend runway with these. Now these do come at a little bit of heavy terms because there's risk involved. These are still risky businesses, so might be a good opportunity, but just see what you're getting into.
Yeah, I would agree with that. It's kind of like a backdoor way of doing venture debt, which is totally fine. But it's basically venture debt at the end of the day. What you can use that for? It's kind of a hack if you are in the manufacturing space or project financing, is treat your partners like investors. And you're not going to be giving away that much capital, but there are many times where the project or the upfront fee for tooling or something is so outside of your bounds, but you need it to move forward, where you can set up an agreement around these same type of relationship where they're going to be charging you half of what they would charge you for the service or the help. And then along the way, you're kind of paying that back in exchange for some small options or something like that. But that you can use your equity as a tool to get up, not just with venture folks, but also like partners that are going to be with you for a while.
Awesome. There's a question in the chat. I'm just going to click share here. How can companies that are aimed at social good, in this person's case, justice tech, access grants or funding by those looking to have social impact and not just financial return? These are hard to find for this person, but also I think this is an interesting topic to kind of tread the line on what's available for people. Oh, Raza just posted an answer right there.
I was typing it as it was coming up, so I just posted it. But I think in general, if you are cause-based and you want to make an impact and not necessarily profits, now the extreme of that is that you're a not-for-profit or non-profit. But we also do see a lot of companies that think that they can make a modest profit and have a triple bottom line or something like that. If you are more on the non or not-for-profit side, then you ought to find, the foundation for justice type foundations for your funding. But if you are, kind of the social impact and can maybe make some profits as well, then you want to find a lot of these social impact funding funds, organizations, and pots of money who are behind, a particular cause or a set of causes.
And I can jump in as well. Like, especially if you're based here in Boston, there are a lot of organizations that are thinking about impact investing, and there's one called the Boston Impact Initiative that I think could be relevant for what you're doing. So just think, I think you'll really be successful to try and find events that are going on around your industry, networking events. You never know who you're going to meet at those events who might be interested in impact investing, but looking into other like, again, foundations and donors is always a great opportunity as well. Family offices as well. That would be an equity investment usually, but oftentimes they have a philanthropic arm of capital and an investment arm, which is usually more impact focused. So both could be good options depending on the technology. So I will not lie and say that family offices are super easy to come by and find. They're not like advertising themselves so much, but to the best of your ability, looking for family offices can be really valuable.
We really fit into this category with Freight Farms, and a lot of our customers did as well. Something you might want to look at is government-backed loans from your local bank. Local banks love community projects, but they don't like risk. So there is a subsection, based on the industry that you're in, that will say, all right, if this project goes off with a hitch, the government is basically the backstop of that loan. And that makes it much easier for them to lend. So we used USDA for that. They were the support mechanism for a lot of local banks so that our customers could go to that local bank and access capital. But we worked with our customers to access that. So there are kind of avenues like that where it might be a traditional lending, but has some type of infrastructure behind it for community projects.
Awesome. Thank you so much for all the information. There's a lot of love for John showing up on Freight Farms. People are asking a little bit more about your journey. I believe if you could talk a little bit more about which platform you used and how did you raise funding? What was the trajectory and path to where are you now?
Sure. Yeah. So we did use Kickstarter, and this was in the days that Kickstarter, you didn't necessarily have to give something away. You should, to try to like get people to put more in, but we were trying to build a 40-foot shipping container, so we couldn't really send that in the mail at that stage. So we really just came up with like fun prizes at every stage. One of them was like on the first Freight Farm we ever built, like your name was like engraved on it, and that still exists out there in the world in a museum, hopefully someday. So trying to find incentives for folks that weren't necessarily giving them the product. I'm not sure if Kickstarter is the best platform for doing that now, but you won't always be able to give away your product in a crowdfunding scenario. So thinking about what makes the person who's donating connect with the product, and even if it is something that's not material, something that they feel like they're part of the journey. From there, we went to Techstars and Mass Challenge, which was, I highly recommend if you are thinking about going from prototype into starting a business. It's a boot camp. You'll learn things that it's MBA in a day. Basically, it's get all the terminology that you are going to hear all the time out very quickly. Techstars actually gave us $100,000, so that was really helpful for us to stop doing our side jobs, right? Like make this our full-time job for a short period of time, and that was essential for us to get that momentum. From there, we went for a pretty easy layup to our Series A because Techstars did a great job introducing us to the network in Boston. Because we had a physical product, we really needed people who were willing to take the day and come in and check it out, and that was really essential, getting that network to buy into that experience. From there, we did a series of raises with our Series A investors, brought on some Series B investors, brought on some strategic investors, and last year got acquired by a company who is looking to take it public. So not as not as succinct as I'm making it. That is a 10-year up and down journey to make that happen. You're always like think you're doing better than you are, and never have enough money to get to the next horizon, but you make it work. And that's pretty much the experience I've heard of every startup founder. Like, you never have enough money. You just got to keep on going. So yeah, it's the grant we got was from NASA. That was a really helpful experience for us. Not only they call it the meatball, the NASA logo, because that's value in itself, that you can just stick that on things and say, like, NASA approved tech. So that was reward enough, but that helped us take some of our tech beyond what we had in our commercial product. We knew there was a lot of opportunity to, like, bring up the production and bring up the performance, but we needed a catalyst to get everything sorted out and then commercialize it. So that was a really big win for us. And it wasn't just like here's the money. Like Jackie was saying, there were checkpoints, but that checkpoint came with more money and different payouts. And that's very common. If you're working with NSF or any other kind of science grant, oftentimes these are multi-year, and if you do a good job, it can be a mainstay of financing to help your R&D grow. So if you get a big fish on the R&D side or the science side, do a good job, because people who get grants get more grants. And it's just one of those things. Getting through the door is the hardest part. After that, after you know the formatting, know how to dot your I's and cross your T's, it gets a lot easier. I'll stop rambling.
Thank you so much. That was amazing. It was a whole timeline of how you've been through. There's, John, just briefly, if you can, someone's asking a clarifying question around, were you speaking about the SBA or other alternative loans, or?
Yes. So we accessed a few different loans for our customers. So we actually had basically a grant writing funnel for folks who came to us and needed basically the shorthand so that they could go to the bank and go to the USDA. SBA loans is what I'm talking about. If you are trying to get a community project going, there is a directory, I believe, of banks that have SBA, like government-backed loans. And yes, that should be available somewhere on the internet. But you can always go to your bank or find your local banks, and you should see it. I think it's a GSA loan. Don't quote me on that, but yeah, check out government-backed loans.
Awesome. I'm going to try and wrap up with this one last question, which is more of a general question. I'm trying to pick questions that will be more suited for everyone in the audience. Someone's asking a really neat question that I also have. How can we best develop a plan for fundraising? I know we've talked a lot about pitfalls. Steph is here. Quickly, if one of you can take the mic and help answer, is there a best practice on how to develop a plan that is never going to be foolproof, but like, if you guys have an opinion, would love to hear one of you quickly chat about that.
Yeah, let's call it the capital staging plan. Startups raise money in successive rounds. Each round is tied to a set of goals that they, hopefully, if they accomplish, increases the value of the company and de-risks certain items. So this is the onion theory of de-risking startup. You peel one layer, there's another one. And each successive round is helping you peel one layer. So, to develop your fundraising plan, you ought to learn about these funding options. You're already doing that by coming to webinars like this. You need to figure out what you're building, what are the value inflection milestones for your company, and then reverse the time, money, and people that you need for each goal to the amount of fundraising round that you need. And, come up with a little capital staging plan that way.
Thank you, Raza. Thank you. Oh, John, do you have a?
I would just add, there's a lot of things that VCs are looking for that they won't tell you that they're looking for. That's probably the hardest part. You're like, why aren't they buying this story? There are stages and expectations for your journey that it kind of gives investors a kind of watermark of where you're going to turn out. So, pre-seed, seed, Series A, Series B, there are things that particular investors really want to see. Others will say, okay, you're on the right track. So it's all about really identifying those milestones and making sure your story tracks to those milestones and you build credibility for the next milestone ahead. I'll drop a nice little chart in the chat here that might help for that if you're thinking about going on your.
Awesome. Thank you so, so much, everybody. People are asking to connect with you guys on LinkedIn offline. Please feel to drop your LinkedIns right in there. And they're all of them are tagged in the Startup Boston LinkedIn post. Feel free to go give them a follow and find these guys there.